every subsequent crisis tends to be more severe than the previous one. For instance, the crises in 1998 and 2008 escalated in intensity. There's a looming concern that we might reach or have already reached a point where a crisis surpasses the Federal Reserve's capacity to intervene effectively. It's challenging to predict when exactly this might occur, as we're dealing with a complex, dynamic system. While it's feasible to anticipate the severity of a crisis, pinpointing its exact timing is difficult. However, the signs are worrying. Looking back, the 1998 crisis was triggered by Russia defaulting on its debt on August 17, 1998, leading to a severe global liquidity crisis. This crisis eventually impacted long-term capital management, which had $1.4 trillion in derivatives. The issue wasn't just the losses in Russia but the widespread liquidity crisis that caused widespread selling and massive losses across various assets. This crisis was eventually contained through a $4 billion cash injection, facilitated by the Federal Reserve and accompanied by interest rate cuts. Similarly, in 2008, the collapse of Lehman Brothers on September 15 triggered a chain reaction, bringing major financial institutions like Morgan Stanley and Goldman Sachs to the brink of failure. The Federal Reserve's intervention was crucial in preventing a complete financial meltdown. Each bailout has been larger than the last, and each crisis more perilous. In such scenarios, it's advisable to invest in assets that are less vulnerable to global liquidity crises. These include tangible assets like land, real estate, gold, silver, fine art, natural resources, water, and energy. For those interested in stocks, focusing on companies dealing in natural resources, like ExxonMobil or Chevron, could be beneficial. However, conventional stock portfolios, banks, and money market funds could be at risk during such crises. It's also interesting to note that the dollar has effectively been a form of cryptocurrency since at least 1979, the last year paper treasury notes were issued. Since then, the nature of currency and investments has evolved significantly, underscoring the need for adaptability and prudence in investment strategies. The last instance when people physically went to the bank to get paid was around 1979. Since then, the dollar has essentially become digital, with encrypted message traffic starting from around 1980. However, the implications for the dollar in today's world are complex, and this ties into the broader theme of unintended consequences, particularly in the realm of economic sanctions. I've advised both the Pentagon and the Treasury, drawing on my experience in economic sanctions and intelligence, about the nuanced impact of these measures. While sanctions can be effective, overuse or overly broad application can diminish their power. When targeted entities, like countries, feel excessively pressured, they might abandon the dollar system altogether, which is a significant shift. This was evident when, for the first time, a central bank's assets were frozen, and an entire country, Russia, with the exception of Iran, which was a more isolated case, was expelled from the SWIFT international payment system. Such actions can prompt the creation of alternative payment systems and currencies. For example, discussions in Saudi Arabia about moving away from the dollar indicate this shift. High-profile individuals in these countries, who own assets globally, are now considering the risk of asset seizure, as seen with the Russian oligarchs. This approach to freezing assets and imposing sanctions isn't just limited to the geopolitical arena. We've seen similar tactics in Canada, where Deputy Prime Minister Chrystia Freeland took action against the truckers' protest by freezing bank accounts and crypto wallets. This approach was so severe that supporting the truckers was criminalized under a new interpretation of Canadian law. These actions show a trend towards more aggressive financial and legal measures against perceived threats or non-compliance, reflecting a shift in how governments exert power and influence in the modern world. The recent actions by governments, such as the Canadian and U.S. administrations, in freezing the accounts of certain groups and individuals reflect a significant shift in how financial power is wielded. In Canada, Deputy Prime Minister Chrystia Freeland targeted blue-collar truck drivers, while in the U.S., the focus was on Russian oligarchs. Despite the differences in their status and wealth, the underlying principle is the same. Both countries have demonstrated a willingness to freeze assets in Canadian and U.S. dollars for people they disapprove of. This approach raises concerns among various global players. Whether you're a Saudi prince, a Russian elite, or a Chinese business magnate, the current climate around the US dollar might seem increasingly unstable. Doubts are emerging about the US government's understanding of the real-world impact of its actions and the ripple effects on the international monetary system. A case in point is the response to sanctions on Russia. When Russia faced extensive sanctions, it retaliated by restricting exports of key materials like nickel, which is crucial for manufacturing batteries for electric vehicles. This ban led to a surge in nickel prices, increasing by 4 to 5 times, and even caused the London Metal Exchange to temporarily shut down. Such tit-for-tat actions in the global economic arena highlight the complex and often unintended consequences of political decisions, affecting a broad range of industries and economies worldwide. In this complex web of economic warfare, the unintended casualties can be surprising. For instance, amidst the US-Russia conflict, a Chinese billionaire who owns one of the world's largest nickel mining operations suffered a staggering loss of $5 or $6 billion due to the surge in nickel prices. This scenario exemplifies how global economic conflicts can produce unexpected fallout in seemingly unrelated areas. Turning to the accumulation of gold reserves, both Russia and China have significantly increased their holdings over the years. Russia's gold reserves have grown from around 600 tons to 2,300 tons, and China's from about 600 tons to approximately 2,000 tons, with potentially more held off the books. This strategic move aligns with concerns raised to the Pentagon in 2009 about these countries bolstering their gold reserves. Regarding the notion of the Chinese yuan becoming the global reserve currency, several key factors make this unlikely. When discussing reserve currency, it's crucial to understand that it typically refers to the currency in which international reserves are held, usually in the form of government bonds or notes, not just the physical currency. China lacks a robust, mature bond market equivalent to that of the United States, essential for a reserve currency status. Factors like the absence of a comprehensive yuan bond market, lack of primary dealers, and the necessary financial infrastructure, combined with the absence of a rule of law and financial disputes, significantly impede the yuan's potential to replace the dollar as the world's reserve currency. However, a hypothetical new currency, backed by gold and supported by a sound legal and financial infrastructure, could present a more viable alternative. For instance, using Swiss banking systems, UK law for governance, and third-party depositories for gold storage could create a credible and reliable new global currency. This currency would require substantial gold reserves to ensure confidence. While the yuan and the Russian ruble may not be poised to replace the dollar anytime soon, the creation of such a new currency system could potentially shift the dynamics of global reserve currencies.